Good morning. Let's talk about something that might sound complicated at first, but with a little guidance, options trading can open a whole new world of financial possibilities. If you've watched financial news, you've likely heard puts, calls, and felt a bit overwhelmed. At its heart, options give you the right, not the obligation, to buy or sell a stock at a set price by a set date. Think of it like a special voucher that gives you a choice. That voucher offers flexibility that simply buying and holding shares doesn't. Options let you speculate on a stock's direction with less capital up front. Options are contracts whose value comes from an underlying asset. Expecting a jump, a decline, or big movement but unsure of direction? There's probably a strategy for it. This isn't reckless gambling. It's calculated risk and strategic positioning. Learn the basics: strikes, expiries, volatility, and practice with a simulator. Today, a strategy for energetic but uncertain markets.
Right, let's get to the heart of the matter. The name long put synthetic straddle sounds like a mouthful, but it's simpler than it seems. You expect a very big move, but you're not sure if it's up or down. It's designed to profit from a big price swing either way. It's a two-part construction. First, buy 100 shares of the stock, your long stock component. Second, buy 2 put options on the same stock, same expiry, ideally near the money. 1 put acts as insurance for your shares. The second put is your downside profit engine. Synthetic means we recreate a long straddles profile using stock plus puts, rather than buying a call and a put. This can be capital efficient, especially if you already own the shares ahead of an event like earnings or a major conference. Shares give unlimited upside, 2 puts cap risk and add downside profit. Together, the position is primed for a large move in either direction. When we talk strategies, know your aim. Steady income or a significant capital gain. The long put synthetic straddle is not an income strategy. It's a capital gain play targeting a substantial price move. Think landlord rent versus developer windfall. You're waiting for a big catalyst-driven revaluation. You pay premiums for puts, and time decay works against you daily. That's theta. So this isn't set and forget. You want the move sooner rather than later. Objective: growth, not recurring income. You realize profit by closing the trade above your total cost basis after a large swing, not by collecting cash flows. It's a speculative play on volatility, going for one meaningful win rather than many small payments. Knowing when to use it is the real skill. It's a specialist tool, not an everyday screwdriver. It thrives on high uncertainty and high expected volatility. A quiet, sideways market is the worst case. Time decay eats your puts. It's market neutral. You need movement, not direction. Best ahead of binary events: earnings, product launches, trial results, court rulings. Enter when implied volatility is low. You're buying vol insurance on sale. Thesis: calm now, event soon. Volatility spikes. Options gain value as price moves away from entry. Avoid if there's no catalyst. A narrow range bleeds premium day by day. Your job: find the quiet stocks with explosive dates on the calendar. Every strategy is a trade-off. Here's the long put synthetic straddles profile. If the stock makes a substantial move, upside on shares is, in theory, unlimited. Each euro higher adds a euro per share, less the cost of your puts. On the downside, 1 put protects your shares. The second put drives profit. As price falls below strike, that second put can gain dramatically. Risk is defined. Max loss equals total premiums paid plus fees. Worst case, price sits at strike into expiry. Shares flat, puts expire worthless. 2 break-even points, 1 above entry, 1 below. You need a move beyond either. The higher your put cost, the further price must travel to profit. It's a bet on a big move. Small wiggles won't cover premium. Let's make it real with ASML, a linchpin of the semiconductor industry. Assume today is 6th of October 2025 and ASML trades around $950. We expect a major announcement to trigger a big move, direction unknown. First leg, buy 100 shares at $950, cost a $95,000. Second leg, buy 2 at the money $950 puts, December expiry about 45 days. If the premium is $30 per share, each contract costs $3,000. 2 contracts are $6,000. Total outlay $101,000, the $95,000 in shares plus $6,000 in puts. You own 100 shares and hold 2 puts. The right to sell 200 shares at $950. Max risk is put premium, $6,000 plus fees. You're positioned to profit on a major move up or down. Navigate to ASML on your broker platform. Place a buy order for 100 shares. Mark it for immediacy or a limit if you prefer control. Once filled, move straight to options. Open the options chain, select the target expiry. Here, December, so 45 days. Find the 950 strike on the put side. Buy to open, quantity 2 contracts. Check the ask, say 30. Use a market order for speed or a limit. For example, 30-10, for price control. After both fills, your account shows 100 shares long and plus 2 long puts. The long put synthetic straddle is live. P&L now responds to price movement and time. Exits depend on direction. Let's take both paths. If ASML rallies to $100, sell 100 shares for $110,000. Sell to close the puts to recover any remaining premium. Approx profit, $15,000 on shares minus for $6,000, put cost $9,000. Less fees. If ASML falls to $800, sell both puts, about $30,000 intrinsic, and sell the 100 shares at $800. Total proceeds, $110,000 against $101,000 cost. Odd $9,000 net, less fees. Crucial, close all legs to lock the final result. It's ideal when you're confident there'll be a big move, but not the direction. The enemy is a quiet sideways market. Theta decay erodes value. Study volatility and catalysts. Start small or paper trade, have a clear plan, and manage risk. So that's it. I wish you good luck with your trades and see you next time. Thanks for watching.